So every month we get provided a newsletter which goes out to all of our clients. And what I wanted to start doing is potentially providing a little bit more context to the newsletter, a little bit more depth. I find that while often the topics of conversation are interesting to a point, they don't generally go deep enough into the subject to really provide much value. And so what I'm going to start doing each month as these come through is doing a bit of a live, react to them, and potentially provide a little bit more insight into the content that we get, which hopefully provides some value. So this month we've got a few key points. We've got some data on the average loan sizes in each state, some news on foreign investors and what they now can and can't do, some potential changes to lending regulation for younger borrowers, specifically with HECS, and an update on consumer car loans in the economy currently. So I'll start off with the first point. Effectively, this is a summary stating that loans are at an all-time high, with the average mortgage across Australia of $666,000, which is an increase of 8.5% from the year before. Interestingly, this is a drop on investor lending, but an increase on owner-occupied. And then it sort of goes on to talk about effectively what are ways that we can potentially get into a property a little bit easier when these mortgage amounts are higher. Now, typically, if your mortgage amount is higher, you've got a $666,000 mortgage, if that's 80% of your property, you're looking at a deposit of circa $150,000, which can obviously be quite tricky to save up. And so there's a few different ways that you can get into a property with less deposit, without putting the dream on hold completely. So firstly, less than a 20% deposit. There are plenty of options. For owner-occupied properties, we can get loans up to 95%. We can get loans pretty easily up to about 88% without the fees being prohibitive. And we can also get loans up to 90 or 95% for certain professions. So effectively, in summary, borrowing 80% is generally easy for everyone. Borrowing 90% for most people is relatively doable without being too prohibitive. Anything over 90%, however, can be quite challenging and get quite expensive on standard kind of products. And then there are special LMI waivers, special products that are available for certain professions, which are not just the ones you typically hear about, like doctors and lawyers. It also extends to nurses. Some banks will do it for teachers. So it's a little bit broader than a lot of people think. So if you think you've got a specific profession that may be eligible, it's always worth reaching out to a broker. You can also look at guarantor loans. If your parents have got a lot of equity in their property, that could reduce the requirement for you to have a deposit. You can effectively use their property in lieu of a deposit to reduce the bank's risk. We are seeing a lot of purchases in non-spousal agreements. So this could be siblings, could be friends, and it's just becoming, I think, something that's going to become more and more common over the next 5-10 years if property prices continue to go the way they're going. And there's specific products that exist out there. So if you are thinking of doing this, before you go straight to your bank or jump into it, again, talk to a broker. There are products that exist that are designed for this. And in brief, what they effectively do, if you've got a $500,000 loan normally, you'd both be joint and severally liable for a $500,000 loan, which effectively means that if you're trying to buy another property, so you're buying an owner-occupied live-in or another investment property, most banks will view you as having a $500,000 liability on half a property that you own. These products exist where effectively, if you're buying with your sister, for example, you'll have a $250,000 loan, your sister will have a $250,000 loan, you both guarantee each other's loan, and it's both secured by the same property. But what that means is that for any of your future plans, when you apply for another loan, you've only got a $250,000 loan, which means your future borrowing capacity is not as heavily affected as it would be otherwise. And it also keeps things a lot cleaner because you've got separate loans, separate offset accounts, separate bank accounts, very clean. You can also look at the home guarantee scheme, which for eligible first home buyers or clients who have not owned property within 10 years. Allows you to get into a property with a 5% deposit only. Now there are income requirements here. Typically it's $125,000 or less for a single, or $200,000 or less for a couple. If you're on the border though, it is based on your previous year's notice of assessment. So it's possible to be making more than that today, but still be eligible. So again, speak to someone if you've got any questions. Obviously you can save more money, which is very helpful. Next point of this article is talking about foreign investors. So they're really cracking down on this, which makes sense. I think that there's already a movement to reduce foreign investment on established properties, because those are properties that Australians can move into now, and having foreign investors who may or may not rent these out, buying them obviously can, not always, but can take supply off the market. So what they're doing is they're cracking down on this, and they're effectively only wanting them to be able to buy new properties, which in theory will open up more properties to Australians to buy, and in theory help with the housing crisis we've got. Now, from my understanding, there's not a huge amount of purchase that's happening for existing property anyways, so it's unlikely to make a huge difference, but I think it is a step in the right direction. This one sounds great. So you've probably seen in the news or on Instagram or something that HECS can be a real challenge when it comes to your borrowing capacity, because the way that the bank will assess this is that they'll effectively take what your scheduled HECS repayments are going to be, so what the deductions from your payslip will be, and they will treat that as an ongoing liability. Now, if you're on a good income, your repayments could be $10,000 a year, $20,000 a year, $30,000 a year, which can obviously significantly decrease your borrowing capacity. Now, if this was a liability that was going to go on for 10 years or 15 years, that would make sense, and it's better to be cautious with these things. But for a lot of clients that I deal with, they might have an assessed HECS debt of $15,000 a year repayments, but only owe $10,000 remaining, which effectively means that in reality this debt's gone in less than a year, and we're assessing the ability to service a loan on 30 years, but they're still unable to get the loan they want because they've got this HECS debt in place. So what they're looking at doing, again, it's still pretty grey at the moment, but putting in some, I guess, advice or guidance to banks, which will effectively say if the HECS is less than a certain term remaining or less than a certain amount, it can either be ignored or reduced. So I think that's going to be good, especially people in higher cost professions. I've got medico clients whose borrowing capacity is reduced by $400,000 because of the HECS debt. Now, obviously they're making quite good income to have this effect, but still, this is quite a significant hurdle for their property planning, especially if they've got a young family. So if there can be some clarity on this and perhaps a more common sense approach, I think that can go a long way to helping people out, especially first home buyers, which is what most people want to help get into the market. Final point the article touches on today is just an increase in consumer car loans, which is interesting. Allegedly we're in a tough economic position, but people are purchasing new cars at record numbers. Now, I guess there's two ways to look at this. One is people are buying new cars, they've obviously got money. The second way to look at this is they're taking out a record number of loans, so maybe they don't have money. So perhaps this is a precursor to potential hurdles in the market. One thing a lot of people are not aware of though is car loans, like HECS debt, like any other liability, can quite significantly affect your borrowing capacity. So we have these conversations with clients a lot of the time. If you have plans to do something in the next 2-3 years from a housing point of view, and you are considering getting a car loan, I would speak with a broker or a bank or someone who can give you an idea of your borrowing capacity and try and model out both situations. So again, we have these conversations weekly with clients where they'll approach us and say, look, I'm thinking about buying a car. However, in 12 months, we're also looking at upgrading our house. Can you give me an idea of how much this will affect my borrowing capacity? Sometimes we have these conversations and we say, look, if you buy this car now, there's a real chance that it's going to affect the ability to buy your dream home. And in that case, they'll often take a step back and say, look, we'll wait, do the car loan until we have to buy the house. In other instances, we can run the numbers, we can see that this car loan makes basically zero difference to their ability to afford a house, which then allows them to go ahead, get the car, and do it without worrying there's going to be any consequences to it. So again, this is just forward planning. If you're thinking about getting a car loan, but you also may have some property purchases in the next 3 to 5 years, have a chat with the broker just to make sure this is not going to negatively affect your borrowing capacity. So that's the end of the first one. Hopefully this is going to be a ongoing thing I do monthly to provide a little bit more context and depth to these articles.